Alright guys, welcome to the second video. So in the previous video we effectively broke down various elements on Apple's income statement and we basically transferred it over to Excel. So this is the sheet that I have basically formatted slightly from the previous video, made it look slightly more presentable so you can copy some of the formatting that I've made here. There is one slight change that I've made to these basic financials, which I'll just highlight now. If you'll recall, we had an element called other income/expense on Apple's income statement, which was this line item right here. Typically, this line item encompasses interest income and interest expense. Now, I have tried to break down this interest income and interest expense into the individual constituents because as you'll see in the future videos, some of the ratios that we calculate depend on the breakdown of this other income/expense. So let me just help you and explain to you how I have effectively broken down this other income/expense. So it's very simple. All you do is on Apple's financial statements, they will break down the constituents of the various elements. So all we do is we search for the appropriate disclosure, and there you go. They have provided us the exact breakdown of this other income/expense. So for 2019, it was interest income of 4961, expense of this much, and other income of this much. So all I have done on my Excel sheet here is broken the other income into its individual elements, and I will show you in the future videos why this is important. Effectively, this net interest expense is helpful in calculating some of the credit or leverage ratios, which we will talk about in the next video. Okay, so with that being said, let's look into the calculation of some of the elements or some of the ratios on this spreadsheet. So here I've created this table called ratio analysis table. And so this is where we're going to be doing some of the computations. So first thing is revenue growth period over period. This is a very simple ratio. All it tells you is what is the rate of growth of revenue across the years. So what I've done here is I have just copied the different revenues in the different years for Apple. I've added one more year here, so I looked at the 2016 financials and just copied this number here. So what am I going to do now? All I'm going to do is I'm going to calculate Apple's revenue for this year and calculate how much it grew by versus the previous year. So this gives me a percentage figure. So all I'm going to do now is I'm going to copy this formula and just paste it over to the following 2 years, and boom, it's going to give me the rate of growth, or more specifically the rate of change of Apple's revenue in the current year versus the previous year. And I've provided the formula here. It's effectively the revenue in the next year divided by the revenue in the previous year minus 1, and it gives us a percentage number. Okay, nice. So now let's go into some of the other ratios. The next one we have here is the gross margin ratio. Now, you'll recall from the previous course that we talked about gross profit. And what exactly is gross profit? It's basically the difference between your revenue and your cost of goods sold. And it gives you a sense of how much profit Apple is making for every good that it has sold across the years. So in order to calculate the gross margin ratio, all we do is we take this gross profit and divide it by the revenue for that specific year. And then we just copy that formula over to the next 2 years, and boom, we'll just calculate one additional decimal point to give us some more information, and there you go. So we know now that Apple's gross margin is effectively stable at around 38%. The next ratio that we're going to look at is the Sgna ratio, which is, so what is Sgna? Sgna you'll recall from the previous course, is sales, general, and admin. This figure encompasses all the expenses associated with Apple's employees, the different properties or rent that it's paying, or effectively in the maintenance of its operations. So what are we trying to calculate here? We're trying to calculate how much are these expenses that Apple is paying each year as a percentage of its revenue. And similar to the previous line item, we just copy this formula over. So what is this telling us? Again, the ratio of, or the percentage of Apple's expenses on sales, general, and admin as a percentage of their revenue is roughly stable at around 7%. Now, let's talk about this next ratio here, which is the Ebitda margin. Now, this is a very interesting ratio, and we don't explicitly have EBITDA here. This is a very important ratio because it gives us the exact figure for the profitability of a company after taking into account the cost of goods sold and also a company's expenses. So if you see here, we've got this calculation here for operating income, also called EBIT. How is this calculated? It's basically your gross profit minus your total operating expenses. Now, what we're going to be doing to calculate EBITDA is we are going to be finding out the depreciation and amortization and adding it back to the operating income in order to calculate the EBITDA. Now again, if you reference back to my previous course, you will exactly understand how and why we're exactly doing this. But in order to calculate the depreciation and amortization, you will remember that this item is on a company's cash flow statement. So let's just quickly have a look at Apple's cash flow statement. Should be on page right here. There you go. And here we have the depreciation and amortization listed. So let's just copy this number over and paste it right here. And so let's just paste it right here. So now we've got the depreciation. In order to calculate EBITDA, all we're going to be doing is we're going to be taking the EBIT and adding back the depreciation and amortization, and then copying the formula over for the next 2 years. Just going to format it appropriately. So there you go. Now, in order to calculate the Ebitda margin, we do pretty much exactly the same thing that we've done to calculate the previous ratios. We take the EBITDA and divide that by Apple's revenue for that specific year, and we copy that formula over for the next 2 years. So just to reiterate, this is a very important ratio, the Ebitda margin ratio, because it gives us a sense of the profitability of the company once you have taken into account both the cost of goods sold and also the total operating expenses on the company's employees, rent, all the administrative expenses. So effectively, if this ratio is very small, it tells us that the company is not super profitable. But if you look at Apple in this instance, we see that roughly it's making 30% EBITDA margin, which tells you that it's a very profitable company. So the net income margin is pretty much exactly the same concept. We take the net income, divide that by the total revenue, copy it over for the next 2 years, and net income goes one step further. It also subtracts from the EBIT the taxes which Apple has paid for that specific year. And that's how we arrive at the net income. So there you go. So we've calculated all the specific margin ratios in this video, and the definitions here will help you calculate the individual ratios. So great. Now that we've completed the margin ratios, in the next video, we are going to look at some of the credit ratios, also called leverage ratios.